Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The Bank of England continued with its stance to keep rates at the previous levels, and if we look at the major central banks, most of them have opted to pause the current rate hike cycle. The real question going forward would be which central bank will be relatively more hawkish or dovish, and that's uncertain question since there is a big geopolitical situation in the mix. Good morning, JK. What are your thoughts on the recent a lot of rate decisions, Fed, BOJ, Bank of England, and talk to us more about your expectations from the market going forward.
Good morning, Swaraj. Yes, the Bank of England, met the expectation of the market by keeping the rates steady. But their statements are also kind of mixed because they think inflation is going to be stickier than they thought previously, which means higher rates for longer. The data on the other side is weak from UK. Recent PMI data has shown that the growth is anemic, if not negative. Business activity contracted for the third straight month, raising concerns that the UK would be heading for a recession. In fact, the central bank said it expected no growth in British economy in July, September, edging up to just 0.1% in the fourth quarter and zero growth forecast for the entire 2024. So that's a mixed picture that we are getting. So if inflation remains high and the growth remains anemic, we are actually looking into a situation of stagflation. But overall, all the four major central banks have kept their policy rates unchanged, but forward guidance indicates that higher for longer will probably hold on and not going to be eased so fast. But what Fed indicated as a tighter financial conditions helping them over the past week, if you look at it, that has actually eased. 30-year yields have plummeted by 39 basis points, and 10-year by almost 30 basis points as well. Even the 2-year has come down, and at the same time, S&P 500 has gone up by 5%. So where is the tight financial conditions now? I think it is all again looking at a very loose financial condition, and markets are on full risk on. Once again, the war-related fall in the equities have actually been recovered to a great extent. The global equities itself is up by 1.5%. And if you look at Japan market has recovered again 5%. So the conditions are not as tight as Powell was indicating. And then once again, this can actually lead to higher consumption and higher inflation. And that means the higher for longer is definitely entrenched in the market. So yields have come down once again yesterday, and we had the 30-year yield falling below 4.80, and the 10-year well settled below 4.70 as well. And the stocks, as I said, they have recovered strongly on the back of what markets read as a dovish statement from Powell, but this is despite some of the picture from the employment giving a very mixed indication. We had quite a few number of employment indicators that was published in the last few days. As we already said yesterday, the ADP report came at 113,000. Slightly higher than last month, but still well below the consensus. The JOLTS data showed the job availability was higher, but the layoffs also dropped, and at the same time the quits rate also dropped. Challenge job cuts yesterday showed that employers announced 36,836 job cuts last month, roughly a 9% increase compared to last year, but it showed lower number compared to September. Weekly jobless claims important, and that rose to 2,17,000 from 2,12,000, and it is expected at 2,10,000. And most importantly, the continued claims, which is indicative of the more indicative of the employment seeking people not being able to successful, is the continued claim benefits rose for the sixth straight week to 1.82 million, indicating that those losing their jobs are starting to have more trouble in finding new ones. with conflicting indicators, so far markets remain focused on monthly jobs report to be published by the government today, where non-farm payrolls are expected at 1,80,000 versus 3,36,000 last month, and unemployment rate remaining at 3.8%. Of course, the focus will be on wage inflation. No, as I said, risk sentiment has been strong of late, and people seem to have sidelined the war news totally. In fact, yesterday, Japan announced a stimulus package to reduce impact of high living costs on the households and helping firms to raise wages and offer support for domestic investment and growth. The measure amounts to around USD 113 billion, and it will be funded by a supplementary budget for the remainder of the fiscal year. And promptly, Japanese stock market have rallied, and as I said earlier, it has rallied 5%. And on the currencies, despite all the relative better news from US economy and not so great news from other economies, dollar has been taking a beating, although not made a new cycle low. But for example, euro went up from 1.0520 to 1.0670, seeing some retreat after that because of expected data on employment tonight, and UK pound as well holding well above 1.21 consistently. Even the dollar yen, which is finding it difficult to break the previous high of 152, fell well short of that and now trades closer to 150.50. There is currencies like Australian dollar and Canadian dollar have made gains, and Canadian dollar has gained despite oil prices being not so, oil prices having retreated quite a bit. On the Asian side, we had the China CXI, Xiaxin services PMI coming at 50.4, much improved compared to September. And we also see the Chinese yuan holding below 7.33 broadly, and it looks like most of the Asian central banks are also very keenly protecting their currencies from falling into new lows. In fact, there was a statement from Indonesian finance ministers today saying that central bank will strengthen the rupiah stabilization measures to be in line with the currency fundamentals. You can see that RBI is not the only central bank who is trying to protect the currencies, the domestic currency, and that was seen yesterday. Once again, rupee strengthened slightly on the back of the dollar index move lower, but that did not sustain, because once again the demand came back into the market from oilers and other outflows, which we have been seeing for quite some time. FII flows for this month, the first 2 days at least, have been on the negative side following big outflows in September and October. Once again, we have seen PSU banks offering dollars at higher levels. So it's very difficult to see a bigger move in the USD-INR without a change in the policy of the central bank. Meantime, the implied vols on the USD-INR have fallen to record lows seen in 2008. And there is definitely a sense of complacency among corporate building because of the RBI's policy. So we are seeing reports indicating hedging activity by corporates are also coming down quite a bit. So on the rupee, still content with the 83.10 and 83.30, holding the range until something big happens or a policy shift happens from RBI. Thank you.
Thank you, JK. And just a major theme which is playing out is the higher for longer, as we see central banks opting for the inflation being stickier commentary. But one thing to note is that the Fed had commented on the yields being higher, acting as a natural tightening measure, but now yields have also dropped substantially. So things to look forward would be if consumption is also bouncing from here. Asian central banks are keenly protecting their currency, as JK mentioned. It's another theme which is playing out in Asia. While rupee also, we saw slight strength yesterday, but it didn't sustain as the demand came back. Now, geopolitics is a very difficult subject to understand with so many variable factors. And if you're keen to understand the current Israel-Hamas conflict and how it might evolve, Do tune in on the 7th November between 5 p.m. to 6 p.m. on a special webinar on geopolitics. And we have a super speaker, Professor Nalapat, who is also the UNESCO Peace Chair. So it's going to be very insightful. Link will be in the description. So do tune in. That's it from us today. Have a very good weekend. Tune in on Monday for the latest of the